Good afternoon, folks. My name is Mike Turner. I manage money for a living. I'm going to show you exactly how I go about doing it. And this is one of the things that I like to do with my clients is I like for them to know exactly the process, why I make the trades I make, when I make them, how I make them. And whether you become a client of mine or not is really not the point of the presentation. I'm going to show you what I think is the single best way to build your portfolio successfully in any market, whether we're in a bear market, a neutral market, or a bull market. So let's get into it. All I can see are lights, so I'm assuming that you're out there. It looks like that you are. So when we get to the point of asking questions in a little bit, I hope I'll be able to see you. Let's get started. What everyone wants to know, and I'm assuming you want to know this. Number one, is the next bear market right around the corner? It's been a while since we've had a good, solid, average bear market correction of about 38% or so. The longest period of time between those types of bear market corrections is 8 years. The longest period of time ever. We're now 7 years in and counting. How long will the next bear market last? Well, a bear market, to really be a bear market, has to last for several years. But a bear market correction can be fairly short and fairly severe. You look at what happened in 2007, 2008. It was only a little over a year in duration, and the market dropped 50%. So it can happen again like that fairly easily. And I get asked this all the time. People come by my booth, or they contact me and they say, what do I think's going to happen, and how severe will it be? Well, the market could reverse, and it could go a lot higher. But when I start looking at all of the things in the world that could push the market higher, and all the things in the world that could push the economies of the world lower, and hence the market lower, it's way more heavily right now on the downside than the upside. How bad will it be? It could be really bad. It could be shallow. And I would be lying to you if I said I knew which way it was going to go. In fact, the way I invest, and I'm going to suggest that you invest, is it really doesn't matter if you're set up properly. I'm going to show you how to do that. Should I stay out of the market entirely until the next bear market ends? No. But you need to know what to do with the market that you're in now. Will the next bear market be worse than the massive drops in 2002 and 2008? They could be. They could be worse. Wouldn't surprise me to be worse. How do I protect myself from the next bear market? Well, you need to be prepared, and that's such a broad statement. I'm going to tell you how exactly to be prepared. Okay? Do I just buy and hope that the next market will eventually come back? It always has. Every market has always come back. So for those of you who have money managers that are telling you, oh, don't worry about it, the market always comes back. They're not lying to you. If they're in a buy and hold strategy, they are categorically wrong and should be fired. But they're not wrong in saying that the market comes back, because it always does. Okay? At least it always has. Hang on. I don't know where that came from, but we're out of that. All right. If we are in a secular bull market, meaning a bull market that's going to last for 10 years or more, looking back in history, if you wanted to take the average of how much it could go from where it started in 2009, it could go up a lot. It could go up, it could more than triple. But it's been 7 years since the end of the last bear market, and the average bear market correction occurs every 4.5 years. And as I said earlier, the longest one's been 8 years, and the average drop has been 38%. So we could go from a triple in the market to a 50% lower or more. So you look out at the world, you say, well, there's China is now doing their quantitative easing. That's worked out really well here in the United States and in Europe. They're struggling to get into a type of economy that is promoted and sponsored and runs by the actual people who live in China and not just being an export type economy. You look at the mass migrations in Europe and how that's overwhelming some of those countries. They're very socialistic in their approach, and it's costing them enormous sums of money, and it's overwhelming them. The Fed could raise rates. The Fed is omnipotent, right? They know everything, right? The Fed does, right? And so if they raise rates, it's the right thing to do. The Fed doesn't know. In my opinion, the Fed doesn't know any more than you or I do. They got a lot of data, and I've seen them make a lot of wrong decisions on the data that they do have. I'm not a big fan of the Fed. Oil could hit 18 before it hits 40. And when it hits 40, the shale world jumps back in and it pushes supply way up and oil goes back down again. So it looks like to me oil has got a top in the 40 range and it's got a bottom, who knows where it goes. But you know what's interesting about oil? In a normal market, lower energy costs should be good for everything maybe except the oil business, but it's not. And so you have to look at the price of oil as not being a supply issue so much as it is a demand issue, and it could well be that the global demand for energy is contracting, and if that's true, then the global economies are contracting, and if that's true, then that does not bode well for a stock market that hinges on global economies growing. A buy and hold strategy, if you're in that, it could kill you in the next bear market. If you're a value investor and a value and growth investment strategies could kill you in the next bear market. A money market or cash strategy doesn't make you anything in a bear market at this point. And here's something that's interesting. If the market drops 50% like it did in 2008, and it comes back at 10% per year thereafter, it takes 7.2 years to get back to even. So you should ask yourself this question: how many 7.2 years do you have left? So here's some interesting facts for those of you who hear what, I don't know, the Buffetts of the world, and you know, I see this come up every time Buffett talks, is that, and he's a great investor, don't get me wrong, but how to trade like Buffett? Well, if you got the money that Buffett's got, you can trade like Buffett. Otherwise, you really shouldn't. And here's some things to keep in mind. In 1929, big crash, the market dropped 84% in about 3 years. It took 32 years to get back to even. The 1965 to 1982 bear market lost 72%. It took 30 years to recover. The 2000 to 2002 bear market correction lost 37%. It took 13 years to recover. And the 2007-2009 bear market correction lost 50%, and it took 6 years to recover. So you could say, well, Mike, see, the market always came back. It always came back. What if there was a way for you to get out of the market just about the time that it begins to crash? And then you'd get back in the market just about the time, a little bit after it bottomed and started back up. And you missed the big down swings and rode the big upswings. What if you could do that? Now, your buy and hold money managers out there will tell you, oh, come on. Nobody has ever been able to, over a long period of time, pick market tops and market bottoms. But I didn't say that. That's a true statement also. You can't pick market tops and market bottoms over long periods of time. You can guess periodically and be right. But what you can do, because it's measurable, I'm going to show you how to measure it mathematically. My background, engineering, computer science, finance. I'm a math guy. I'm not a guess guy. I don't know where the market's going to go a year from now or 5 years from now. I don't know what IBM is going to do. I don't know what AT&T is going to do. But I do know where they are right now. I do know where the market is right now, and I know how I should be in the market or not in the market right now because I can measure where the market is right now. And in your mind, you should be saying, well, Mike, how does that help me? Because fine, I can measure where the market is, but I'm for the future. I want to find out what I can make in the future. I need to know what the future is going to be. You can guess at it, but here's the thing that's interesting. If you keep your money in sync with the market and you have a strategy for each of the only three conditions of the market, which are bullish, neutral, or bearish, if you're always right with the market, your money will always prosper when the market prospers. And it will not get devastated when the market does not prosper. And I'm going to show you exactly how to do that. So, when you get through watching this presentation, you're going to, I hope, know what I know. It doesn't matter what the market's going to do. You're going to be prepared for it. You know, come into the office, you know, and I got my monitors all up here, and I'm watching all this stuff, and I've got CNBC on, and Squawk Box is running, and they have an interviewee come on, and they interview him. And I always have, visually in my mind, I've got these little signs that pop up behind the guy that's being interviewed, where I say, guess, lie, no clue, because they're always asking what's going to happen. Do you know why buy and hold is so promoted? And it is the most promoted methodology for investing that's out there. Here's why. The money managers who promote buy and hold, and if you're a money manager in the audience, my apologies up front for what I'm going to say next, because I believe this to be true. They want you to continue to pay them a fee long enough for their mistakes to be recovered. They want you to have a 5 or 10-year investment horizon, not because that's good for you, not because in all of the analysis, I just showed you facts about how far down a market can go and how long it can come back. They being the money manager, they need to have that much time for the market to come back so that they can say to you, see, we got you whole again. I think that any money manager who promotes buy and hold should be fired. Every one of them. Now, there are going to be exceptions. Some of you have got stocks that you have owned for decades, and your basis is next to zero, and you want to hold them forever because they have a good yield. Fine. I have no problem with that. That kind of buy and hold is fine. But if you're investing in the stock market to grow your capital, buy and hold is an egregious methodology. Okay, so here's what I do. I have what I call the market bias. It exists in 3 conditions: bullish, bearish, neutral. The market never exists in 2 of them at the same time, only one. Where do you think it is right now? What? Neutral. Okay, you think it's neutral right now. Well, you're darn close. So in a bull bias, what I do is I get 100% invested, and I recommend you do this, in fundamentally strong, blue chip, uptrending stocks, fundamentals and technicals. In a bull market, you're all in. Okay? In a neutral market, it is the most risky period of time that the market can be in because you do not know whether it's going to come out of that neutral market and bend up into a bull market, come out of that neutral market and bend down into a bear market. It is the most difficult period of time to predict. And if it's the most difficult period of time to predict, then the best thing you can do is go to cash. That's another thing a lot of money managers don't do. They're scared to death of cash. You know why? Because they're afraid you will call them and say, why the heck am I paying you a management fee to sit on cash? I can do that and not pay you a dime. right? And so they believe cash is an abhorrent position to take. It's a strategy for me and my clients. So you want to raise cash, you want to use tight trailing stops. By the way, every position I'm in, you'll hear all kinds of talks about this stock is great and that stock is great and this industry is great and that industry is great and on and on. And someone recommends a particular stock. Do you know that every stock that I recommend and I put into my clients' portfolios, I have a downside exit on every one of them, just in case I'm wrong? I know what the exit strategy is on every position I take. And if that stock drops enough to trigger in price, I don't care how good the company is. I don't care what the management team is like. I don't care if the value proposition on them. I don't care. What I care about is making money for my clients. I want to buy here and sell here. I want to buy here and sell here. I don't care. It's just a piece of paper. That's all we're buying. When you buy Apple, you're just buying a piece of paper. It doesn't matter what the management team, the CEO, it doesn't matter what they do. It doesn't matter about the products in the pipeline. It matters that you can buy here and sell here. That's what you want to do. That's all I'm interested in. Now, do I want to only own high-quality stocks, meaning that they've got good fundamentals, good return on investment, on and on, pay good yields? Yeah, I want all that. Yes, I do. And I'm going to show you here in a little bit how I rate, rank, and score that. But at the end of the day, I want to buy here and sell here. Most investors do a really good job of buying here and selling here. I'm going to show you how to avoid that most of the time. Does that mean that I win on every trade? I do not. That's why I have a downside exit on every one. I use volatility to measure my downside. The thing that you want to do if you're holding a stock is know the difference from, and you got to watch me on this, okay, because I don't have a slide for it. You want to know the difference between volatility as a stock climbs higher, and the difference between that and a downtick that says the trend has changed direction. And if the downtick says the trend has changed direction, you want out. If the downtick is just volatility, you're going to stay in. And the way that I measure that is pretty simple. It's just a mathematical formula. I take one standard deviation of normal volatility on a stock, or calculated over a 12-month trailing history, to determine how much that stock can move against me and still be in an uptrend. So I take that one standard deviation, subtract it from the previous week's lowest low, and that's my stop. And that stop stair steps up. And when the stock begins to dip down and it dips below that stop, I'm out. It's just math. In a bear market, I want to stay 50% maybe or so invested or less. If we're in a long-term bear market, I might get 80 or 90% invested, but I'm going to look at inverse ETFs. I'm going to look at contra-trending stocks. You know, over the last couple of months, the market's been horrible. We've had 2 double bottoms. But there have been a couple of segments of the market that have done pretty well. Some of the REITs have done really well. Some of the utilities have done really well. They've really bucked the trend. You want to look for those. But you want to primarily, your job in a bear market is don't lose capital. In a bull market, everybody ought to be able to make money. You should make money in a bull market and outperform. You know, another thing that a lot of money managers say that their objective is to always beat the market. You think that's a good objective? No, it's not. If the market drops 40% and your portfolio drops 35%, they have succeeded. They beat the market by 5%. That's crap. You should have a money manager who says, I'm going to try to beat the market and keep you profitable. Both. It takes both. Okay? All right. So here's the last 10 years or so. And this is nothing more than the S&P 500. It's got a 200-day moving average. And that yellow band is one standard deviation of normal volatility around that 200-day. And I don't know whether you can see it on your screen or not, but if you're green, you're all in the market bullish. If you're in that yellow zone, you go to cash. And if you're red, you have a bear bias strategy, which means you're going to mostly hold cash. Consider contra-trending stocks, but not, you want to stay small, very small. Your objective is to not lose money. So in the 2008, the market dropped 52% from peak to trough. It took over 5 years, nearly 6, to get back to even. So here's how market directional trading can work. And I wish I could point oh good, that'll show up. You see that line right there? That's when we get small, stay in cash, look at small amounts of inverse ETFs. We don't make a lot of money in a bear trending market because it's too risky to try to guess when that end's going to occur. My job in that period of time, when it's in this area right in here, is to stay small and in cash. You'll notice right down here where it broke through, where the market broke through that yellow zone, that's when we pick it back up and we start getting in fundamentally strong, uptrending stocks. Each time you see one of these flat areas, it's when we go to cash. All these are flat areas. We're flat right here. Now here's what happens in this type of strategy. If you had buy and hold, well, you made 22% over a 10-year period, roughly. You like that kind of return? That's better than losing money over 10 years. But you lost 50% back here in this period of time if you said buy and hold, and that's only 2 3/4% a year. If, on the other hand, you'd used a market bias, market directional approach, you'd have been up 82%. Nearly 10% a year. Same market. All you did was go to cash at the right time. And it wasn't magical to know when to go to cash because you can measure it. When the market moves from above that yellow zone, and you can say, well, Mike, I don't have a yellow zone. I can go home tonight, but I ain't got no stinking yellow zone. Okay? Well, you can go anywhere and get a 200-day moving average, right? And you can calculate what a standard deviation of normal volatility. Worst case is use a Bollinger Band. The point of it is you can determine where the market is right now. Is it above that yellow zone? Is it below it? Or is it in it? If it's in it, you go to cash. If it goes below it, you want to have a bear bias, mostly cash. Stay very small in your investments. Look at inverse ETFs after a 4-month trend lower. Be very careful. Worst case is you stay flat in cash and you make nothing. If the market stays in a bear market and stays that way for 2 years, 2.5 years, and you don't make a dime, what's better than not making? What's way worse? Let's put it this way: than not making a penny, losing 50%, right? So every week, I send an email out to my clients, and I say, okay, here's this chart. In fact, they get to see this chart every day. It's updated all the time. Here's where the chart is, and here's where we are. And they know exactly what I'm doing and why I'm doing it. They want the 80%, not the 22%. They want the 10% per year, and I'm not promising that. I'm just saying this is what the strategy would produce. They don't want the 2 3/4. So here we are. We've got these 3 conditions of the market and 3 different strategies. So in a bull bias, here's what I do. I want to outperform the market. Yes. I want to concentrate on blue chip, fundamentally strong, uptrending stocks. It's a fundamental analysis and a technical analysis. By the way, let me make sure you understand where I would come from. You could take a stock that's got great fundamentals. Awesome. I mean, it's the greatest company that the world has ever seen, okay? I would never buy a stock because of its fundamentals. You've got another stock over here. This is the great, beautiful, great stock, great products, great everything. And you've got another stock over here. It's just crap. They produce nothing, okay? and it's got a technical trend that's going skyrocketing because some rumor came out, and it's really going up. I would never buy that stock because of its technicals, even though it's going way up. They have to both be together. What does that mean? I want to only own high-quality stocks that are trending higher. High-quality stocks can trend lower. Case in point, Apple. Great company. If you've owned Apple for a year, my condolences. You've gotten crushed. It's a great company. It'll come back. Yeah. But why own it when it's going down? Buy it after it bottoms and comes back up, starts coming back up. Buy it on the uptick. Don't hold it on the downtick if the downtick is a change in trend. And it changed trend back in May of last year. All right. Always assume that you are wrong, and stupidly so. Okay? You can have a lot of guys on this stage. They got big names. I know a lot of them. Several of them are good friends of mine. You may not know me from Adam. Okay? But let me tell you, nobody knows what the future is going to be. Nobody does. It doesn't matter who they are. They just have an opinion. I have an opinion. I think the market goes a lot lower than where it is now. I think it's headed way down. But it may not. It may go a lot higher. I don't invest my money or my clients' money based on what my opinion is of where the market's going to go. I invest our money in where the market is, not where it's going. Because if I'm right where it is, more times than not, it will continue in that direction. The market never goes from a bull cycle to a bear cycle in 1 minute or 1 day or 1 week. It doesn't do that. It always goes through a neutral zone. And as long as I know that, and that's true because it always has, the moment it goes into that neutral zone, whoa, I'm going to cash because I don't know where it's going now. And that's measurable. I don't have to guess about that. It's also never wrong to take a profit. I know you buy something, here's what happens to you. You buy a stock and it goes way up and you're proud of yourself. You think you got it all together. You tell your wife, your husband, look how smart I am. You know, I really did this. This is really good. And then it starts dropping. Just go back to Apple. Let's say you bought Apple 3 years ago, 4 years ago, 5 years ago. It skyrockets up. You're a genius. Begins to roll over. You're not going to abandon that because your ego is tied to that. You've invested in that stock. Not just money. You've invested who you are in that stock. You don't say to yourself, oh, it's just a piece of paper. You don't say that, but you need to say that. When you buy a share of Apple, you don't own Apple. You own a piece of paper. So don't get emotionally tied to any stock. That's the worst thing that can happen to an investor is emotion. And we're all emotional beings. I love making a profit for me and my clients. I love that. I feel good about it. I don't like losing on a trade. I feel bad about it. But those things get in your way if you let them dictate how you invest. Go back to the math. The math is unemotional. It either is or it isn't. It's binary. A 0 or a 1. It's either bullish, neutral, or bearish. It's not going to be both of them or all three of them, ever. It's one or the other. Okay, so here's what I do. You probably can't read this. Go home and look at it on the playback. But here's a group of about 12 different fundamentals that I rate, rank, and score. I got about 4,500 stocks and ETFs in my database. And I rate, rank, and score. My computer system does this for me that I developed, my rules, my methodology. And you can kind of look at the stars there on this particular stock. Doesn't matter what it is. You can see I've got maximum 5 stars on, I got revenue growth, earnings growth, revenue year over year, multi-year, return on equity, relative PE. And I've also got relative fundamental rating. Let's just do that one next to the bottom. Relative fundamental means this. I'm looking at the fundamentals of this stock compared to the fundamentals of every stock in that stock's peer group, its industry. And I rank it within that peer group. I don't care how it ranks within the overall market. I care how it ranks with its peer group. So this tells me that if I've got a stock, in this case, this one's got, 75 out of 100 points. That tells me it's got good fundamentals, almost great. 80 would be great. 75 is very good. So we have a computer system that does this analysis based on my rules that I developed. I don't use somebody else's. There's a lot of good systems out there, but I like mine. And we only consider stocks that are the best of the best. And the operative word there is consider. Doesn't mean I'll buy that stock, but it becomes a part of my small universe that I will consider owning at the right time. Technicals and the market give me the timing. Fundamentals tell me what. Technicals and the market tell me when. And this ensures that I buy only the highest quality stocks for my clients. So here are the technicals. Not a lot. What trading zone is in? I don't want to get into a lot of detail of that, but basically, is it in a bull cycle, a neutral cycle, or a bear cycle? Is it overbought? Is it oversold? That sort of thing. What kind of volume? You know, it's easy to get into any stock. It's getting out that's hard. And by the way, most investors don't have any problem with buying. They have a hell of a time selling. But you don't make money buying. You make money selling. It's when you get out, it's when you make money. Just if its industry is in a bull mode, sector's in a bull mode, then that means rising tide lifts all boats. Market's in a bull mode, all that's positive. And so what I use is the fundamentals tell me the universe to consider, the market bias, and my technicals tell me whether the timing is right or not. Okay. So here's what I would do. For example, I'm just going to give you an example. Let's just say that I want to look at all of the strongly bullish stocks. This is a screen that I use. And bullish and strongly bullish. And I want to look at stocks that are just in the utilities section. And I want to make sure that they've got at least 3% yield. And up they pop. And now I can go look at them individually and decide which of those that I want to get into. Now, don't go out and buy these. This is just for example. But this is how I go through the process of whether or not I want to be in the market by the market bias, that yellow band on the 200-day moving. And by the way, I don't just use the SPY or the S&P 500. I use the S&P 500, the S&P 400, the NASDAQ, the Dow, the Qs. So here's a screen, and you can't see this at all. Just kind of trust me on it. This is one screen that has all of that information on it. The technicals, the fundamentals, the sector, the industry, all that's on one screen. And so when I go through, I look at the technicals, the fundamentals, the momentum, the insider buying, the sector trend, the industry trend, the rating, the ranking, the profile, the institutional ownership, the downside exit strategy, all that's on that one page. It's a great page. I developed that system, and I'm not selling that system. I'm telling you this is what I use. And I use the overall market to tell me whether or not I should be in, neutral, or bearish in the market. So, in a neutral environment, that's what I do when it's bullish. In a neutral environment, I want to move to cash, take profits, utilize a tight trailing stops. I plan on being 100% cash by the time I get out of the neutral zone. Remember, the neutral zone, we don't know whether it's going to break to the upside in a bull, downside to a bear. So what do I want to be? I want to be cash by the time the market leaves that zone. The market's never moved from a bull trend to a bear trend in one step. Market's never moved from bear to a bull in one step. The market always goes through a transition or neutral zone, and it's the highest period of time for risk, so you want to go to cash. Last item is a bear bias. What do I do in a bear bias? I want to preserve capital. It's better to make nothing than to lose a lot. I want to stay delta neutral, maintain a good mix of contra-trending stocks and inverse ETFs. I'm not afraid to hold cash, a lot of cash. If the market moves back into the neutral zone, I invoke the neutral zone strategy. And the market just this week moved from a bear bias into the neutral zone. Just barely moved up into the neutral zone. Barely. Always assume the market can and will reverse. Always maintain a downside exit. Always assume the trade will move against you and what you're going to do if it does. So if your husband buys a stock or your wife buys a stock, and the first question you as the other side of that partnership should ask is, when are you getting out? And you almost never answer that question. But you need to answer that question the moment that you buy it. When is not necessarily days in the future. It's when the price gets to this point. I bought it here. If it drops to here, I'm out. Okay? All right, here's the summary. Never follow, buy, and hold. Never. Well, I made the one exception. You got a zero basis in a stock and it's paying you a good dividend. Fine. Hold it forever. Stay unemotional and unbiased. Okay? Always have a downside exit strategy on everything. Always assume the market could reverse course. Always have the right strategy for the current market. Quit guessing. Quit listening to the analysts on CNBC or whatever you listen to, IBD. It doesn't matter. Quit listening to the forecasts. They don't know. You think somehow they put their pants on differently than you do? You think that they've got some great insight that you don't have? No, they're just in the business. They may have a lot of insight. I think my opinion's better than a lot of people. Doesn't mean I'm right. So you need to make sure that you spend more time analyzing where the market is, not where you think or Kramer thinks or anybody. And all these guys are great. I mean, it's fun listening to them, but they don't know. Never base your investments on where you think or hope the market's going to go. Quit listening to the analysts and the talking heads. They're all guessing. Here's another thing. And you can do this. I wrote a book on it. Go by my booth and pick it up if you want. You need to have a rule for every market condition. If someone says to you, well, what happens if the market skyrockets next week? Well, you got a rule for that. What happens if the market tanks next week? Well, you got a rule for that. What happens if it goes down and goes right back up? You got a rule for that. You got a rule for every condition, not only at the market level, but at the stock level. Okay, this is almost my last slide. Then I'll take questions. Why buy and hold is egregiously wrong. You know, when I took the test for my RIA, and FINRA had the test, I had to take the test with the concept in mind that buy and hold was right, or I couldn't have passed the test. Now, far be it from me to say that FINRA is wrong, but I can just look at the math and tell you that's wrong unless, well, you're going to live forever and you never need the money. FINRA's right in that regard. FINRA's supposed to be there. These regulatory agencies are supposed to be there to protect you from people like me, people who are supposed to be professionals that will mislead you. And I think that's a good idea. I think they should. But they're not always right in their philosophy with regard to what's safe and what's not. Most investment managers will tell you that the smart investors, not the riffraff, the smart investors, don't change investment strategy just because the market moves up or down. They say that because they don't know how to deal with the market moving up or down. Don't worry about bear markets. The market always comes back. Translation, keep paying me your fees, and eventually I'll make you whole again if you pay me the fees for enough number of years. Because the market will eventually come back, and despite my terrible investment strategy, I'll look good eventually. Trying to time the market, excuse me, trying to time the market is a fool's game, and no one can do it successfully. Translation. Nobody can time the top or the bottom, but you can time the market. You need to have a long-term investment horizon. You'll do fine if you're in it for the long haul. Already talked about that. If you plan on living forever and don't mind losing massive amounts of money in a bear market, and you never need the money, then maybe buy and hold is a good strategy. Most money managers, and here's the thing that's really important. I know this firsthand because this is how I got my first exposure to money management. I hired a money manager. And you know what I learned? He's better at marketing than he is trading. 2 years too late, I fired him. You want a money manager who actually manages money, not marketing. All right, so here's the two charts. Ask yourself if you want the top line or the bottom line. Oh, by the way, I don't know if you have a sheet that Sue was handing out at the back, but if you do, then there are two reports, Profiting in a Bull Bear Market. This basically the background behind what I've just described to you about making money in both bull and bear markets, and how to select the right asset manager, how to take an objective view of it. They're both white papers that we've developed, and if you'd like to have a copy of it, fill that out, put in your email address and your name and all that kind of stuff that's on the sheet. And if you want to talk to me about money management, there's a checkbox there for that as well. And then turn it in to Sue, who is at the back of the room. So make sure you turn that in. Okay, I've got about just a few minutes left. I'm open for questions. Yes?
During a severe correction or bear market, value stocks don't go down as fast as growth stocks. Am I wrong?
Okay, the question is this, or statement basically. In major bear market corrections or bear markets, value stocks do not tend to be as volatile to the downside as growth stocks. Am I right? Was that the question? Okay. Yeah, there's some truth in that. Let me tell you about value stocks versus growth stocks. The next time you go to the store, instead of taking any money with you, just tell the cashier that the stock that you own has got more value than you want to just trade the value. You just want to sell the value. You want to buy something with value. You can't do that. I am not, and no offense to anybody on that. Yes, you can maybe hedge yourself a little bit by focusing on value, but let me tell you, the old excuse of saying, well, if a stock drops in price and is therefore almost by definition, its value proposition is better because it doesn't cost you as much to buy it anymore, doesn't help you if you bought it here and it's down here. Value to me is something that you begin to add emotion to a stock. Now, I know there's a way to quantitatively measure value versus growth. I clearly understand that, okay? But I don't put any stock in it, pardon the pun. I'm after high-quality stocks, which tend to have a little more value, but I'm after high-quality stocks that are trending higher, okay? Any other questions? Anyone? Got a question? Yes, sir.
If we were to evaluate you in selecting a money manager, how would we see what your historical performance is?
Okay, so here's the question. In fact, I think I wrote, I put it in the flyer that was in your bags. And that was when someone looks at a company like me, a money manager, and they say, I'm going to evaluate you, the first three criteria that they consider are performance, performance, and performance, right? Because that's what I'm always asked. Someone walks up to me and they say, well, how did you do last year? Well, I did about 6% net of fees last year. How are you doing this year? Well, I'm flat this year. Why are you flat this year? Because we're in a bear market area of my market buys. And of course the market's down, so we're nicely beating the market. But the point of it is that yes, performance should be a criteria. But you should clearly understand, you should never hire a money manager who says, trust me. I know what I'm doing, and I've got some really good staff. You know, the money manager I hired, this was years and years ago before I got into the money management business. I just sold my company. It was a high-tech company. We built software, enterprise-level software systems for the pharmaceutical research world. And I sold it for the first time in my life. I had money. And I thought, wow, okay, I'm going to kind of enjoy life a little bit. I'm going to take this big bucket of money. I'm going to hand it to this big-time Wall Street guy, and I'm just going to have fun. And I went in after the first 6 months and sat down with him. I had to set up the appointment, by the way. He never contacted me. So I set up the appointment and went in, and we were down quite a bit. And he says, oh, listen, don't worry about that. He says, the managers I've got are far exceeding the Lipper average. And I thought, what the heck is a Lipper? So every time I would talk to him, he'd bring up this Lipper thing, the Lipper average. And I know what it is, okay? But it didn't matter. My money was going down. By the time they had lost 45% of what I had worked all my life for, I finally did what I should have done the first 6 months, was to fire the guy and decide I couldn't do any worse managing it on my own. Well, that led to, I'm an entrepreneur, so that led to another company, actually 3 other companies. But the point of it is that, yes, you should ask about performance. And yes, we did well last year, and we're doing well this year. But the thing that you need to and you go back to 2008. 2008, that's when I started. That's a great year to start a money management firm, right? 2008. You know, I can pick them when it comes to starting a company. And I started that company, and the market was down nearly 50%. And December of that year, I remember like yesterday, December about the 15th of that year, we were up about 6%, and the market was way down. And I mean, I thought, wow, this is awesome. Our first year, this is awesome, okay? And then the last 2 weeks of the year, we just got crushed, and we ended up being down about 4% for the year. I so wanted to have a positive year in a terrible year like that. But my point is that you need to know more than someone just to say to you, here's my performance, trust me. You could have someone with great performance because the market was conducive to that performance for that period of time. You need to know how they make decisions. I wish I had asked that money manager that I hired, how are you making decisions about my money management every day? How are you doing that? You should ask, you should feel free about asking me that. You should know, you should be able to go. If you're a client of mine, you're going to be able to go to my website, because it's password protected for just clients you can get into, the area I'm talking about, and you can go there and you can see how this chart's moving every day. And you can know exactly what my strategy is every day. All right, I've got about 30 seconds for one more question. Yes, ma'am? Yeah. How many clients do I have? Okay. I'm relatively small. I've got less than a couple hundred clients. Let me get some more water here. Feel like Marco Rubio. I'm not going to bring up politics. Okay. So we're relatively small. I've got less than 25 million under management. Tiny. I'm not a $1 billion guy yet. And I've got less than a couple hundred clients. Any other questions? Time for one more, maybe. Anyone? I don't think yes. Say again? Do I have a newsletter? Every week, yes, I do. The question is, do I have a newsletter? Every week, I send out a newsletter to both my clients and those who are interested in knowing what I'm doing, but it's not client-oriented. So, yes, fill out that form that you should have handed out to you, and we'll put you on that list. Thank you very much. Hope you have a great show.